Recording in progress.
Hello. Yo. Yo.
Yeah.
Mike,
Yo,
is my voice echoing?
is your what?
Does my voice echo when I talk to y'all?
Nah, I don't hear you echoing.
Uh,
I go from boy.
Yeah. You are. All right, guys. Yeah. Um, Oh man. Excuse me. Happy Father's Day too, by the way, man. Um,
Name out.
let's do this. Let's get into it. So this is the this is the monthly ES. These are the June contracts. We're probably gonna be rolling over next week, probably Wednesday, probably Tuesday, Wednesday, or something like that, maybe Friday. But the contract's gonna be rolling over. Got quiet within this week. So with all that being said, let's just go over the technicals. This is the monthly chart. So from from previous Zooms, we talk about, we should know what liquidity is, right? So
Right.
we find liquidity in gaps, swing highs, swing lows, volume imbalances, etc. Right? So from a monthly perspective, you had this monthly gap that we traded into in April, right? That we traded higher in May. We trading higher this month. This month is not yet over. So if and when I believe we close above this red candle, right? This red candle should support any idea you have of taking a market higher.
That's the monthly?
Just the monthly. Yeah. Now, granted, we still in the month. This candle is still printing that we're in right now. But if this candle that we're printing right now closes above this red body candle, then the idea of you taking the market higher from this point, from 53.17 higher, what should be supported. And I'm gonna explain why. When you sweep liquidity, which this candle did, there's this fair value gap. Inside of this fair value gap is liquidity. It's a bunch of water. Take all that water out of there, bring it higher, right? So if we close this monthly candle on top of this now becomes an order block. So now your order block is supporting any idea you have to take the market higher if it's traded back to. Now this is the monthly time frame. So I'm not saying, the 1st of July, you take a trade from here and go higher. No. This is what I'm saying is just pay attention to what happens if price does return to this candle, if we close above it. So the market does something freaky and starts selling off, and then this candle becomes a red body candle with a wick on top of it, then we got a different story. But from a monthly perspective, the market looks like it ain't trying to stop. Right? So let's go down to the weekly. So from a weekly standpoint, you have, let me take this off. Let me take this off right quick. All right. So from a weekly standpoint, you have a few inefficiencies below us. One being this fair value gap right here that we touched. Remember, we slid into it about 2 weeks ago and never came back. So now you have liquidity below this candle, which is it's a low. This is not the swing low, but it's a low. So you got liquidity below this, right? So you have no other inefficiency to the upside, so the market can continue to the upside. It can keep going, unless I put the field decisions and stuff on now, which is that's Winston's specialty. But just from an eyeball, we just eyeballing the chart right now. The market is screaming bullish. So the only inefficiency that we have below us right now on a weekly is this fair value gap. right now. We have some stuff that's lower. You know, down here we got gaps and stuff down here, but this is the nearest inefficiency. And this gap starts from 52.15 all the way down to 51.65, and we have 54.37 right now. So that's like what, 200-300 points in a sense. So from a weekly standpoint, the market, in my opinion, is still bullish, right? So now let's get to where we find our bias and our trades. Now let's go down to the daily. Now the daily, bro. So we still have this gap that's still intact. We traded into it. We haven't filled it. We came close to filling it, but we haven't filled it. We have this gap. We also have another gap that's beneath us. That we dug into a few times and we haven't filled it. Now, there's a few reasons why this gap didn't fill, right? You have this, you could call this a level right here, inside of the gap that we bounced off of 3 times and used it as support to go higher. And then we displaced again, creating another gap, traded into that gap on Friday and traded higher. So from a daily perspective, I'm under the impression that the market still wants to go higher. It's showing no signs of reversal just yet. It's showing no signs of retracement just yet. Is steadily climbing. Now I will say this: we got quiet witching this week, so that could induce some selling. Most times it does because you have to sell your contracts. Most people have to sell it. You know, everybody had to sell their contracts and turn over to the new contracts. So it does induce some selling naturally because we got to get out of our positions. So when that does happen, then I think we do have a few news events this week too. But until that happens, I'm just going based off what I'm seeing in the market right now. And when we go to a smaller time frame, we'll be able to break it down a little bit more in depth. But right now, this is what I see from a daily perspective. You know, liquidity pulled it. Liquidity probably gonna go higher. You gotta take your internal liquidity, external, which we did with this. We traded into this gap. This was your high. Boom. Take that. Displaced beyond this high. So we took this internal liquidity, external. So we're gonna have to 9 times out of 10, we're gonna take this internal liquidity, external. So let's go down to the full and see what's going on. Now, okay, so now you have more information on what's happening here. You got a little bit more information. So let me squeeze the chart a little bit. Yeah. All right. So we got a little bit more information here. We have more candles, and it's kind of telling us a story. So everybody know what this is called, right? Don't all answer at once.
Consolidation.
Consolidation. Right? So when you have consolidation, the very next step out of the consolidation is what? Expansion. Boom. Be expanded to the downside. Cool. So when we expanded, we sold off a bit. Boom. We took out this liquidity with this candle. Reverse, we started trading higher. Now we traded back to the consolidation. So now the trick is to wait and see what we do with this consolidation. Is this consolidation going to be resistance, or are we going to trade straight through it and go higher? I believe we're going to go higher, but that's just me. But just following the rules: consolidation, expansion, retracement. You got your retracement back to the consolidation. So the next step is either We gonna continue, or we gonna reverse and come back down. So all signs point to how we, in my opinion, how we use this consolidation right here. So, but if I'm being 100% honest with you, bro, I think, so we have these relative equal highs up here. I think once we sweep this liquidity and we trade a little bit higher, I think we reverse. Because I think, in all honesty, I think we want to return back to this consolidation right here. Because you notice, like, this was the move. This was not the move, but one of the moves that really took us, you know, what's this CPI? This is a CPI candle? Whatever news we had last week. I don't remember. CPI, PPI, whatever. It took us, that displaced us above the range, right? So I'm looking for the market to return back to this consolidation because we never came back to it. So since we have these relative equal highs up here, which is liquidity, let me draw a line. Since we got this liquidity up here, I'm looking for the market to try to attack that and see what we do. Do we reverse and trade back into the range? Or do we continue to displace higher for higher prices? That's what I'm looking for this week. Now, my gut is telling me that, you know, we're going to have a nice pullback this week. Just because we have quiet witching and contracts rolling over for futures traders and whatnot, you know, and monthly contracts expiring and all that good stuff. And then we'll have a nice healthy pullback. But from a technical standpoint, this is what I see. Right? This is what I see. So even here, this consolidation is pretty strong. Consolidation, expansion. We never return back to this consolidation. So I'm looking for a price to come back down here, especially here. This I believe this is a daily gap that I got highlighted here. So I'm definitely seeing, I want to see how price returns to these gaps. And also, let me go back to the daily.
Oh,
I'm gonna see this right quick before you about to say when?
bruh, I didn't hear none of that. I'm wondering why it's so quiet. I just see like your mouth moving. And I had closed the app out on the phone. So that's why I couldn't hear you. I'm like, is he saying something? Like he trying to, the mouse was just going back and forth. I'm like, well, I don't hear nothing. I seen the app close down. I was like, oh shit. I
Man,
missed the whole,
man, missed the whole lecture.
The whole 4 hour. I missed the 4 hour. I heard the daily.
Yeah. So this is my this is like something that I notice in the market, and if you know, and if you notice it too, then you know this is just me. So like when we have a displacement gap like this, and we trade back into it, and then we go higher. So in my humble opinion, to me, this means that okay, we pulling this liquidity out of this gap. So when the market does return to said gap, it's probably going to trade straight through it because it has nothing in its way because we got all y'all out of here.
It's a very upsetting thing too. Because that bitch will come fill that whole thing and don't give you no entry.
The whole thing. And so this, like from previous Zooms, we talked about the 50% rule, right? We always talk about the 50% rule. You got a displacement gap, market is highly likely to trade 50% of that gap, which we did here. Trade the 50% of the gap and go higher. Now, from a daily perspective, I don't recommend you taking this trade. From a daily, if you find this, if you see, okay, we trading back into this daily gap, but you find it on a smaller time frame to take that trade, if the smaller time frame telling you, hey, I could buy this, then do it. But just looking at the daily chart and be like, all right, I'm gonna put some resting orders here at half of this gap and trade that I don't recommend that because the daily will take you for a ride.
Mhm.
Like take your whole account from you. So finding these trades, like me and Winston always mention, finding it on a smaller time frame. He always mentions a 10-minute. I'm always on a 5, even sometimes the 3-minute. You find a setup that's bullish, you be like, all right, cool, I'm taking it. But then, when we get to the smaller time frames, you find your entries and your exit. But the daily is telling you, hey, it's time to get long. So if the daily telling you to get long and you find your entry on a 5-minute, you take it to the next draw liquidity, and you know how that go. No need for me to keep saying that. Y'all know what it is. Let me take this off though. So going back to the 4 hour. So
Hey, where we at right now?
what you mean?
What number are we at?
54.35.
75?
Yeah,
All right.
that's when we closed down on the 4. So now that we return back to this consolidation Friday evening, I want to see how it's used. Is it, because if we use it as quote unquote resistance, then of course you're gonna expect lower prices, and you know what your price targets are, right? From a 4 hour perspective, your low. So this will be your first price. Well, I ain't gonna hold you. This will probably be your first price target. 5408, and then 53.98, and then so forth and so on. But also keep in mind, you have these gaps down here that haven't been touched. The market could trade straight through this if it wanted to. Because if the market is distributing to the downside, when the market sells, it gets really, really aggressive and really, really fast. So the objective for me going into the week is seeing how we use this 4 hour consolidation. Now, the 1 hour tells a slightly bit different story, and we're going to get into that right now. It's kind of the same, but so we'll go down to the 1 hour. So we go, in my opinion, what the 1 hour doing with all these lows, see how you notice how, all right, so let's start here. This was the high, right? Just the high. We traded back into this gap, right? So we took this internal liquidity, external. We swept this high. See that? So now this is the swing high. So now we engineering liquidity here. So now we also engineering liquidity to the downside, because you see all these swing lows we got that we created Thursday and Friday. We got all these swing lows. The market is sell off hard and the reverse, leaving all these lows. So what was happening is the market is engineering orders to return back to the downside. So now you got some free game right quick. Why? So then you have these relative equal lows right here. That's very attractive to the market. Very attractive to the market. Because now you have people that are long in the market. It stops below this, and it stops definitely below this. So when the market does reverse, we want to attack those orders. If it reverses, we want to attack these orders. So with this happening on, I think this was CPI. This was the CPI candle, I believe. When we created this displacement gap, we traded into that gap, like I said earlier, took this internal liquidity, external, and this has been a high that's been protected ever since. Notice how we'll get close to it with this candle, but we didn't touch it. So if we're protecting this high, it's for a reason. We're protecting it to come back to this engineering liquidity. We're getting more orders up here, more orders. So now when the market does return back to it and take it out, it's highly likely that the market should reverse and come in the opposite direction and take this liquidity and bring it down to the other side of the range. So in my opinion, this is engineered. We got this high. We could have took it out, but we didn't. So we got this high right here, engineering liquidity. We got these lows. Well, we got nothing but liquidity down here. We still got this displacement gap that we traded into. We hadn't filled. So, like I said, we pull orders out of it here, we pull orders out of it here, and we pull orders out of it here. So when the market does trade higher and start selling, you ain't got to worry about this gap. The bottom of this gap could be your price target, really. So we still, even if we start selling, if we sweep this high right here, and we start selling from, let's say, R1, you best believe that when we trade back into this gap, you might as well, like, look, this is my price target. I'm gonna trade this whole gap fill 53.92. Because it's nothing left, it's dried up. And it took me a while to learn this about gaps, you know what I'm saying? Because when I first started learning about gaps, I thought that all gaps were like the same, but they're not. The gaps that are created like this, these displacement gaps, or like gaps that come from news candles or whatever, these are the gaps that get respected the most. And as you can see, we've been respecting it. So you could kind of call this like a big old consolidation for real, because it's a consolidation on the 4 hour. So this is definitely a consolidation on the 1. And this is the higher consolidation. This is the lower consolidation. So you're looking for action. And all right, let me break it down a little further too. So when you have a consolidation like this, right? So like we were taught to, when we got a breakout. So when we break out of this consolidation and the market returns back to the swing high, you buy the swing high. And then I'm not gonna say Michael, personally, I used to get cooked on this trade, and I couldn't figure out why. Because if you told me if we close above a swing high, then my entry should be the swing high to take it higher. And what I'm realizing is we could close above a swing high and then go higher with the next candle and start selling. And I didn't know that before. Okay, when I really learned about like liquidity and high risk and where it is, I'd never in my life buy another swing high. Because I know what's going on now. So unless we absolutely displace above it, like I'm talking about close at like 56, at 54.75 or something like that, and then we come back to this area to use this consolidation, then I'm gonna buy the consolidation, but I'm not gonna buy this swing high. But you sweep this liquidity and reverse, come back to the downside. So I always used to get caught up, like, okay, so for instance, let's just say we close at 54, like say we close at 54.57. I'm like, all right, cool, we close above it, I'm gonna buy this. And then the very next candle opens up, trades higher, comes down, and then comes down. So I get picked up and body slammed. I'm trying to figure out what happened. This is what happened. We took this liquidity, we took this buy side liquidity. Now we're going to take it to the sell side of the range. So the sell side of the range as well. Either if you have an inefficiency, like a gap, order block, whatever the case is, that's where the market is going. Or if you have a clean range with no inefficiencies, we go into that swing low. And that's when you see the market get really, really aggressive. It's like when we don't have no inefficiencies that's stopping us from moving in the direction that we want to move in. That's when you see the market just do like a clean run to the downside or a clean run to the upside, because there's nothing stopping it. So even on this price leg right here, this green price leg, there's no inefficiencies. There's no gap. There's nothing. All we got is this volume imbalance right here. And then the market is going to trade straight through that, because what's going to happen, we got to put a red candle next to this. I hope y'all got your notebooks out. Get this Father's Day sauce.
We ain't talking about barbecue.
Hey,
either.
yo.
Get this Father's Day sauce. So the market is highly likely going to put a red candle next to this. Got to. It's a volume imbalance. No bodies. It's just naked. Hangman. Market gonna put a red candle next to that. Reason why you gonna put a red candle, because this move is to the upside. So in order for us to balance this out, we got to come back and be like, all right, we got to put a red candle next to it. And it's highly likely that when that does happen, your boy gonna be in that, I'm gonna be in that trade. And this probably gonna be my price target or this one. It don't matter. Depends on where I get in at. But so going into the week, bro, I'm looking for the market to take this high out and then kind of like reverse and come back down and see what's what. It could keep going. I ain't gonna hold you. The market could keep going. And market could do whatever it wants, to be honest with you. But just speaking solely on from a technical standpoint, you know, things to make you go, this gap kind of stopped us. We respected it. Interesting. All right. So I'm about to break the rules. Go down to the 5 minute. So this is the high on a 5. Matter of fact, let me go back to this chart and just do it like that, so that way I don't confuse anybody. All right. Yep, that's the high. This is the 1 hour gap that we traded into Friday afternoon. So this is why I like the 5 minute. So we call this candle is a displacement candle. Why? Why is it a displacement candle? Because we displaced out of the range. We displaced into a 1 hour fair value gap. We respected that 1 hour fair value gap, but we only traded to. This is why you got to know what you know, buddy. We traded to this order block, this 5 minute order block right here. This 5 minute order block. We traded back to it and respected it. So higher prices to come, I believe so. Like I said, I would like for the market to take this liquidity and return it back to its rightful owner down here somewhere. So from a 5 minute perspective, you have plenty of opportunity to take trades and get out of trades. Like what I'm learning is like sometimes we like to catch the whole move. Like if it's a maybe a 50 or 60 point move, like we want to catch that whole move. But like I'm growing to understand that I don't really need all that. I just need what I need so I can get off the computer. So most times I'm looking for increments of 10 points, right? So most times you enter a trade, especially on the 5 minute, you can find increments of 10 points, right? So if we breaking this down, let's just break the 5 minute down for a second, right? So on this is Friday's price action. So Friday, this is normally a trade IT. So you trade it higher, little consolidation. We displace below the swing low. Once we displace above the swing low, we create a fair value gap right here. I'm gonna draw it out. You can see it. Small gap. Right? We trade into that. So normally I'm selling this gap. Sell this gap, you're looking for 10 points. So if you enter this trade at 54.2150, you want to take this trade to the very next swing low or even lower. If you feel like the market is extremely bearish, then you probably gonna try to hold this trade. But hindsight, we don't have to do hindsight right now because we see what happened on Friday. So, but if you enter this trade at 54.2150 and you're looking to take it to the swing low, right? So you enter here, you're looking to take it. So you're taking it here, right? And that that would yield you about 11 points, right? So if you're looking for trades in increments of 10, so even on the ES with 2 contracts, that's $1,000. 4 contracts, $2,000. 6 contracts, so forth and so on. 1 contract is $500. And you know where you're getting in, you know where you're getting out. You see what I'm saying? And it is precise. So let's break this down even further. So now we trade down, take out this swing low. But if you continue, if you look a little further left, we have relative equal lows right here. So we took that out too, right? So we reverse, create a small gap, but that's not important. It is, but it isn't. Reverse, trade higher, and come back into this. Now, why did we stop at this candle? What is this candle called? This candle right here. This red candle right here. Why we stop right there?
Sure. Hold on. Where you at?
This candle right here. Why did we stop at this candle? Right, when we traded back lower, why did we use this candle for support?
We use this candle for support. Hold on. I feel like you're asking me a trick question. Is
No.
it just simple order block or
It's a simple order block.
okay?
It's a simple order block.
Like I
And
was zooming in and out like this is too easy.
so let me
What you
explain.
talking about?
let me explain. So
Nah, you fucking spooked me out on that. I was like, what fucking message? Is it
So-
just that simple?
So look, so remember I told you the strongest order blocks sweep liquidity, right? So this candle swept this candle, swept these 2 candles over here, swept liquidity, made a move to the upside. Market reverse, came back, said, I'm come pick y'all up. Boom, hit the order block and kept going. But see, on a 5-minute, it's different. It's easy to see these type of trades on a 1 hour because it's less action. But on a 5, it's like you gotta know exactly what you're looking for. Like you gotta know, okay, this is what I want. So even this trade, right here, this is a time-based trade. So normally between the hours of 9 in the morning and 10 in the morning, the market is going to give you a gap to trade. And normally that gap is going to yield you 10 points. At least 5, but most times 10. And if you don't believe me, let's go to another day. Now, I'm going to say this though. It don't always be on the 5-minute. That's why I started using lower time frames. Because that you find your trades on lower time frames. Like the 1 minute, not God forbid me for saying that. The 3-minute. Mostly the 3-minute though. So let me see something. Hold up. Let's not do that. No, we ain't gonna do that. I don't want to even get into that with y'all. We're gonna just keep it right here because this zone gonna turn into a 3-hour zone. So most times, like when I come to the market, like I come to the market like I try to get to the market about 6:30, 7 each day, just to see what kind of price action we get. So if you're looking for a time-based trading model like this, between 9 and 10 o'clock, get your fair value gap. You got to have a displacement candle below the low, close below the low. You got to create a fair value gap. Once you create a fair value gap, you enter here, put your stop above the high, and you take it to the next swing low. It's highly likely there's going to be a 10-point trade. Once you get your 10 points, you get out the market. That's it. Now this is just for futures traders. This stuff happens on all charts. on all equities, on all stocks. It happens. If you want to trade it like that, if you know, but it's more, I feel like it's more lucrative trading on futures market because, you know, you're getting ticks. So for a 40 tick trade with 2 contracts, you know, that's pretty good. That's a pretty good trade in my opinion. You know, so every trade you take, it ain't gonna be the 30, 40, 50 point home run. You know, I take these, I love base hits. Then you take a base hit and say you strike out. So you enter here and you get stopped out here, you're not losing that much money. You know what I'm saying? So that's why I be on the 5 minutes so hard, because I could like gauge trades to where I know this is gonna be my profit target and this how much money I'm gonna lose on this trade, because this is where I'm putting my stop at. When you do that on a higher time frame, it's hard to gauge because those candles have much more depth and they move, you know, more than what you would like, just, you know, without you using a smaller time frame. So that's why I always hop on using a smaller time frame. So just going over the price action, bro, from Friday, like I was doing. Like we got this order block, we traded higher. Once we traded higher, we created a gap. Market traded into that gap, used that gap as support, we traded higher. Now, when you see things like this, I'm gonna highlight this too, because I want to give y'all the game, bro. I want to give y'all the game. When you see stuff like this, you see a gap, and then another gap overlapping it like this. So you got a gap to the downside, then the market immediately reverse. We hit this order block, we reverse, create another gap. So notice how we closed above this gap with this green candle. We closed above it. So now this is a balanced price range. We balance now. There's no reason for us to go any lower. So you could take, if you want to, you could buy, you could trade this, the top of this gap, and take a little heat. Most times you're not going to take heat. It really depends on how the market is trading. You gauge this trade if you want, but this is just another trading setup that you can take. So we sell off, reverse, close, immediately back on top of this gap. You can use this gap as support. And you can see we respected it. But keep in mind, we created a very small fair value gap right beneath it, and we traded into it, and then we took off. So even taking this trade from 54.19, you're looking for at least 5 to 10 points. So without these candles being printed, you're looking for the next swing high that hasn't been touched right here. So you look here, you'll be like, all right, cool. So 54.19 to 54.33, that's a nice trade. And that's the high. You're looking for this. That's all you're looking for. You're looking for the market to take out highs. Boom. So even here, you're going to be like, well, I'm going to get out of 54.32. That's the next swing high.